Hey everyone, I'm here. Today we redoing a quick but thorough breakdown of Salesforce. It's SCRM, fresh Q2 FY2026 earnings. The good, the bad, and the is this a turnaround? Reed, let's get into it. The good first, let's walk through the highlights. Then we'll tackle the bigger picture. Starting with the fundamentals, Salesforce delivered a beat on both top and bottom line. EPS came in at $2.91 versus $2.77 expected, and revenue at $10.24 billion versus $10.14 billion expected. Pretty solid considering how choppy the macro remains for enterprise software. Second, it was a solid showing for growth. Revenue grew 10% year over year, 9% in constant currency, which is nothing spectacular but still respectable given the tough compare to last year. Subscription and support, which makes up for the bulk of the revenue, also grew 11% year over year. Keep in mind that Salesforce doesn't report bookings anymore. But according to analyst estimates, Q2 bookings were up 8% year over year. Third, AI and Data Cloud momentum is building. Data Cloud ARR now stands at $1.2 billion, up 120% year over year. What's really impressive here is that over 40% of Data Cloud and Agentforce bookings came from existing customers expanding their usage, not just new logos. And Agentforce, the generative AI platform, continues to gain steam with over 6,000 paid customers. Management shared some stats on AI adoption. For instance, Einstein GPT adoption across the entire Salesforce ecosystem hit 1 million users in less than 5 months since launch. They also noted that while 6,000 customers are now paying for Agentforce, most are still in the pilot to production phase. So we should see acceleration in the quarters ahead as these pilots convert to production. Fourth, margins remain strong. Non-GAAP operating margin hit 34.3%, marking the 10th straight quarter of expansion. And what's impressive here is that they achieved this while investing heavily in go-to-market. Sales and marketing costs increased 16% year over year. R&D jumped 21% year over year, and total headcount grew 20% year over year. Fifth, big customer wins. In Q2, Salesforce closed more than 60 deals worth $1 million or more, which was notably more than $1 billion. And what's encouraging is that many of these seven-figure deals bundled Data Cloud and AI, highlighting expanding use cases and broader adoption. Some notable wins include Pfizer for CRM and Data Cloud, Marriott for Data Cloud and Service Cloud, and the U.S. Army for Data Cloud and Experience Cloud. And sixth, shareholder returns. Salesforce returned $2.6 billion this quarter and boosted its buyback program by $20 billion, bringing the total to $50 billion. At this pace, buybacks will account for about half of Salesforce's total capital return. All right, now let's shift to the bad. Well, the numbers look decent at a glance. Shares fell roughly 4% after hours as the Q3 guidance disappointed, despite the beat in Q2. Management guided to a Q3 revenue of $10.24, $10.29 billion, which implies 8 to 9% year-over-year growth, slower than this quarter's 10%. Analysts were expecting about 9.2% growth, so the midpoint is right in line. But given how Salesforce has been beating expectations lately, the market was hoping for an upside surprise. To be fair, there are signs of improvement, but it's early days. The primary driver of the shortfall seems to be enterprise softness, which management also highlighted on the call. The second piece of bad news is that AI adoption is still early. While Agentforce boasts more than 6,000 paid customers, management is still in the pilot to production phase. As mentioned earlier, most customers haven't rolled out to production, so we should expect more modest revenue contributions from AI in the near term. In the grand scheme of things, this is actually a good thing. It shows that customers are taking their time to adopt AI, which is critical for such a transformative technology. And third, management is sounding cautious on the macro front. They reiterated the importance of cost discipline to offset any potential demand softness. We all have to see how well they strike the balance between hiring more AEs to drive growth and maintaining strong margins. In a nutshell, Salesforce is showing solid operational execution. Margins are strong, AI Data Cloud growth is explosive, and customer expansion is healthy. But the market is hung up on slowing growth guidance and enterprise renewal weakness. So shares could remain choppy until there's proof that AI adoption is translating into sustained, broad-based revenue acceleration. Now let's talk about the elephant in the room. Is this a turnaround? I'll share my thoughts and reasoning. But before that, some food for thought. The narrative around Salesforce has shifted significantly over the past year. Last summer, the market was focused on whether Salesforce could ever be a high-growth company again. There were concerns about competition, changing buying dynamics, and the loss of key customers. Fast forward to today, and the sentiment has done a complete reversal. Now the market is trying to figure out how fast Salesforce can grow with AI, when the stock should be valued at a premium, and whether it's a turnaround story. So you can appreciate why management might be feeling a bit uneasy. It's hard to predict where the market sentiment will shift next. Anyway, here's my take. Yes, in my opinion, Salesforce is showing signs of business improvement. Take a AI-driven upsell, for example. The fact that 40% of AI Data Cloud bookings came from existing customers suggests stickiness and expansion, not just hype. And that's because companies that are adopting Data Cloud and Agentforce are seeing the value firsthand. Data Cloud helps them centralize and activate their first-party data, unlocking insights and efficiencies across the organization. Meanwhile, Agentforce enables employees to leverage AI to work smarter, not harder, boosting productivity and satisfaction. So it's not surprising that existing customers are expanding their contracts rather than sticking with the status quo. Second, mid-market resilience is intact. The commercial segment in regions like the UK, France, Canada, and South Asia continue to grow nicely. In fact, commercial subscription and support revenue grew a whopping 21% year-over-year. This resilience is driven by the increasing importance of CRM and AI for businesses of all sizes. Third, cash flow is improving. Salesforce raised its FY2026 operating cash flow growth guidance from approximately 10% to approximately 12%. Citing strong performance in the first half, this increase is mainly driven by better-than-expected margins, which in turn boosts cash flows. Fourth, the initial success of AI adoption. While only a small portion of Salesforce's customer base has fully adopted AI, the initial traction is promising. Key metrics like agent adoption, Einstein GPT usage, and lead flow suggest that customers are finding value in AI, which bodes well for future expansion. Finally, management is talking the talk on AI. CEO Mark Benioff said that AI represents the largest opportunity in the company's history, and they've made significant investments in products, talent, and go-to-market, signaling their commitment to AI. It's still early days, but these investments are starting to pay off. So the question is, what will it take for the market to start giving Salesforce credit for these improvements? Well, the answer is simple: sustained revenue acceleration. And based on Salesforce's recent performance, it's not impossible. In fact, it's looking more likely than ever. The real challenge will be to maintain this momentum. Anyway, that's it for now. If you found this breakdown helpful, hit like, subscribe, and let me know in the comments. Thank you for watching. See you next time.